This is Dr. Fenor, and today I'm going to speak about just 12 tax deductions that really disappeared in 2019. I know many of you just found that your 2018 tax returns it was a lesser refund than normal. And because of that lesser refund than normal, a lot of us are a little bit angry. But what we need to be is very prepared on what's to come as far as taxes are concerned. Okay, so technically, we experienced a lot of tax cuts, and because of the Tax Cuts and Jobs Act of 2017, and eliminated a lot of beneficial just deductions and credits. It's been the largest overhaul over 30 years, and it affected everyone in some type of way. And most people won't know until they fill out their tax forms, because we're not all just engaged in this type of information. That is just very difficult information to understand. So I'm going to give you a little summary of what really changed in 2019 as far as the tax deductions, mainly those of the itemized deductions, right? So the standard $6,350 deduction, personal exemptions, unlimited state and local tax deductions, a $1 million mortgage interest deduction, an unrestricted deduction for home equity loan interest, deductions for unreimbursed employee expenses, miscellaneous itemized deductions, a deduction for moving expenses, unrestricted casualty loss deduction, alimony deduction, deductions for certain school donations, and deductions from tax extenders. Okay. So what we're going to do is I'm going to just give you a brief summary of those 12 itemized deductions that I mainly referred to. Okay. The $6,350 deduction. Some of the best news of the tax reform law is an increase to the deduction. There was an increase. While single taxpayers were only eligible for $6,350 standard deduction last year, the amount nearly doubled in 2018 to $12,000. Married couples will now get a standard deduction of $24,000 in the year of 2018, up from $13,000 in 2017. So it went up, so that was a good thing. The head of household filers will see a bump in their standard deduction from $9,550 to $18,000 in 2018. So now that's just for the standard deduction. What about personal exemptions? The increased standardized deduction will welcome the news of many households, but there's a catch. There's certainly a catch. Personal exemptions have been eliminated. So that's why the standard deduction has increased, because they were eliminating some other things. It's not technically a deduction, but the exemption allowed taxpayers to subtract $4,050 from their taxable income for which each dependent they claimed. So if you have many kids, such as maybe 3 or more kids, it may be a detriment to now have an increase in the standard deduction, but a decrease in the personal exemptions. The increased standard deductions help soften the blow of it, but again, you're in a worse off position depending upon how many children that you actually have. The unlimited state and local tax deductions. On this year's tax forms, deductions for state and local taxes, also named SALT, are capped at $10,000 as opposed to being unlimited. It will particularly affect those living in states like California and New York, which both have above average income tax and property rates. So if your state has higher taxes, then naturally it's going to affect you because of that. Now the $1 million mortgage interest deduction, and of course that depends which state you're living in as well. I mean, it may be California, it may be New York, it may be New Jersey, right? So several states have the the higher mortgages in their area. So maybe it doesn't affect you in your state. But another change that could disproportionately just affect you is the restriction on the amount of mortgage interest that can be deducted. Last year, married taxpayers can essentially deduct interest on a mortgage up to $1 million. This year, they'll only be able to deduct interest on a mortgage up to $750,000. Right? So it may not bother a lot of us, but those in the higher income brackets or with the higher mortgages, it will definitely affect. Now, there's been an unrestricted deduction for home equity loan interest. The tax law eliminates the unlimited interest deduction for both new and existing home equity loans. Okay, homeowners used to be able to deduct interest for loans taken out for any purpose such as debt consolidation or travel. Now only interest used for loans for home improvements are eligible for the deduction. Okay. Plus, the combined total of first mortgage and a home equity loan can exceed $750,000. So if you're just taking out the home equity loan just for, I don't know, to consolidate some of your debt, you're not going to receive any tax benefit from that. So you better come out with a good reason why you're taking on this debt. Now, for those of you who usually have unreimbursed employee expenses, usually you are able to deduct any amount that exceeded 2% of your AGI, or adjusted gross income, on the 2017 tax return. But you won't be able to see that deduction available on your 2018 tax return. So those type of individuals that are nurses, that are contractors, that you're an employee of an organization, but you're still buying things such as your uniform, such as certain tools, you won't be able to deduct any of that anymore for right now. There was also miscellaneous itemized deductions. Unreimbursed work expenses is just one of the several miscellaneous itemized deductions that have been disallowed under the new law. Fees for financial services, for example, used to be able to deduct advisor fees and tax preparation fees, but those are just disappearing from now on until we create a new act. There used to be a deduction for moving expenses, but now that has been eliminated for virtually all workers. There used to be unrestricted casualty loss deduction. In 2018, only those in presidentially designated disaster zones can deduct casualty losses on their tax returns. That means that if your house burns down, but your insurance doesn't cover all your costs, you can't write it off on your tax return. Yeah, you can't write it off. The alimony deduction. In the past, couples could set up an alimony agreement that would allow the person making the payments to get some type of deduction on their tax return. That won't be an option anymore, at least for this year. You won't be able to deduct alimony anymore because it's not taxable to the recipient. And since alimony is no longer considered income, the recipient can't deduct any of the legal fees associated with it. Now, there's been deductions for certain school donations, right? Some colleges and universities require alumni to just make donations before they were able to purchase a season ticket or something. The donation to the school used to be some type of deduction to that person, right? Donations tied to the right of the purchase of tickets are no longer deductible for the 2018 tax year. Each year, Congress passes legislation extended temporary tax breaks, known as tax extenders. These include deductions for college tuition and fees and mortgage, insurance premiums, but now legislative leaders have now yet to approve tax extenders for this year. It doesn't look like it's going to be passed. Right? So those are 12 elements, 12 tax deductions that disappeared this year in 2019 that is going to affect you. So take caution, read, try to understand as many tax laws as possible. So even if you have a tax accountant, that you're definitely educated and having good quality conversation within your tax accountant to have the proper tax planning formula.